Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'll be discussing flows, estimated net flows for the week ended January 28th, 2015. The conventional fund business for the first week in four actually took in money. $8.6 billion came into the conventional fund business. Again, this is ex-ETFs. We'll talk a little bit more about ETFs later on. But it was the reason I bring it up as first week in four is we actually had a very volatile week. If people look back to the prior Wednesday, they'll see that we had actually one of the better days that we've had in 2 weeks' time for the Dow and S&P and the like. But by the end of the week, actually it was on Tuesday that just passed, we actually saw the worst week in three. So it's really been a lot of volatility. And what brought that volatility around is we had some mixed economics. We had poor earnings reports from the likes of Microsoft. We had the Greek elections that people they didn't go really crazy about, but they were certainly nervous about. And of course the FOMC came back and said, hey, listen, we're going to keep the rates, or our plans to actually raise rates, right in our hip pocket. So the investors saw this as a hawkish stance that in fact maybe by middle of the year or maybe by September they'll start raising interest rates. So people kind of took a dive for cover. So we saw the markets actually go down, but interesting enough, again, inflows come in. So it kept really investors at bay. Let's see how that behavior, though, turned into flows for the mutual fund industry. Let's take a look at our macro groups. Equity funds took in about $1.9 billion, pretty amazing number considering what went on during the week. Taxable bond funds, though, took in a whopping $6.3 billion, nice number for them. Muni bond funds added about $0.8 billion to their coffers, and money markets saw an outflow of about just $0.3 billion, one of the lower figures that we've been talking about for quite some time. So now let's go ahead and turn our attention towards equity funds in particular, so we can get the idea of what happened in flows in that neighborhood. Equity flows, again, were up about $1.9 billion. It's the fourth week in five that actually we've seen positive, first week in five that we've actually seen positive inflows. But as we take a look at it, we had negative returns, 0.51%. This is the fourth week in five that we've had negative returns. So really, that's kind of a story that's been going on. So I had kind of a head scratcher. We saw negative performance, but money come in. How this broke out, domestic equity funds took in about $1.3 billion, and this is the first week in five that they've actually seen inflows. And then we took a look at non-domestic equity funds, and they saw about $0.6 billion of net inflows as well. It's the first week in three that they've seen flows. How it broke out, if we took a look at the kind of our subcategories, large cap core funds actually took in money about $600 million. And then we take a look at, believe it or not, gold and natural resources combined together took in about a little bit over $200 million. So that's where the flows came in there. International equity funds, interesting enough, even though we had the Greek elections and then kind of some issues over there where the folks that were against the austerity movement, basically, saying we're not going to pay back our debt, they won. It's the kind of leftist socialist group that won in that group. Basically, people kind of shrugged that off and put about $600 million back to work in there. However, if we take a look at emerging markets, Japanese funds, if we take a look at Pacific ex-Japan funds and Pacific region funds, they took in a little under $300 million. That's actually really good flows for that group considering what went on in the markets in Europe and in Asia. So why don't we go ahead and turn our attentions now to the ETF group. And for the first week in four, we actually saw flows into that group about $900 million. At the top of the group, kind of in line with what we saw over on the open-end side, Spider Gold actually took in the largest chunk of change. About $500 million came into that group. iShares Russell 2000 took a little bit under $400,000. And then we took a look at the Spider S&P 500, and the Spider S&P 500 at the very bottom of the group lost about $3.7 billion. So even with that big outflow, we saw inflows. So really, the lion's share of funds out there actually took in money. Another loser on the S&P side was the core, the iShares Core S&P 500. They actually lost money as well. About $900 million came out of their group. Well, now let's turn our attention towards fixed income funds. And the fixed income funds for the fourth consecutive week actually took in net new money, $6.3 billion. And it's the third consecutive week they've had plus side returns, but only to the tune of about 0.12% for this week. And if we broke this down and take a look at the detail, corporate investment grade debt funds took in $2.3 billion. the fourth consecutive week they've seen inflows. But really the head scratcher here, remember I was telling you we had increased volatility, you had the kind of the worst week, the best or worst day and the best day for the week in like 2 or 3 weeks. But we really saw high yield funds take in $1.8 billion as the second week in 3 they've taken in money. And like I said, it was just an amazing feat to see them do that. It was probably the best flows that we've seen since September. Not that long ago, but certainly kind of a head scratcher when we saw the increase in volatility. Usually we have a relationship between equity funds and high yield funds, right? Because they're both risky assets. But this week there was kind of a separation, at least as far as performance went. Loan participation funds, even though the Fed came out and said, hey, our plans are going to continue on and maybe raise interest rates, we think the economy is strong enough, loan participation rates nonetheless lost money again, about $500 million, 29th consecutive week they've seen outflows. Well, let's take a look now at the ETF universe and see what happened in that group. $2.6 billion in net inflows, third consecutive week they've seen inflows on their side, on the fixed income side. iShares iBox high yield fund, so this is certainly something that happened as well. Told you it was kind of a head scratcher for the open-end universe. It certainly happened as well on the ETF side. So iBox high yield ETF took in about $585 million. iShares short treasury bond ETF took in about $441 million. But then if we take a look at that next one down, you got treasuries taking in money. So I think what it is investors are really confused on where to go. Economy seems to be tooling around, and we hear some bad news, and investors really just are perplexed on where to put their money. If we take a look at the bottom end of the group, though, PIMCO Enhanced Short Duration Fund or Short Maturity ETF actually lost about $78 million, so not a big deal on that one, but certainly that's where we saw outflows in the fixed income group. Let's take a look at Muni Bond funds and see what happened there. $801 million where it came into that group. That's a fairly strong inflow. Fourth consecutive week, they've seen net new money come into their coffers. This is the fifth consecutive week that we've actually saw a positive return. Actually, we had one that was just a little bit above zero, so that's where you're seeing double zeros. Fourth week down, but 0.15%. So people have been. It makes sense right around tax time, right? January, February, as people are preparing their taxes, that they start thinking about tax-conscious investing. So that might be it as well. Now, when we're taking a look at a deeper piece of that, though, National Munis took in about $654 million. This is the 14th consecutive week that they've actually taken in money. So we do know that people are actually putting money to work in single states as well. That's how we got to the $801 million of money coming into that group. Let's take a look at our money market funds group. For the fourth consecutive week, they've lost money, $0.3 billion, so just a little under. I think it was 270 and some change or something like that, but a little bit less than $300 million actually went out of their coffers. How that broke out, though, taxable money market funds actually took in $2.2 billion, and of that, institutional investors patted the coffers of about $5 billion versus retail investors taking out about $2.8 billion. And if we take a look at tax-exempt money market funds, that's where the lion's share of money actually went out, and it brought us into our negative. $2.5 billion out of tax-exempt money market. It makes sense. I just told you people are putting money back to work into both taxable and tax-exempt bond funds, so that's certainly where that money probably went as well. So let's take a look now at what we're looking at this week. We actually heard that oil jumped today about 8% in the last portion of the trading day, so that's certainly going to make some people take a look at what's going on. Also, we saw that a release on the 30th was that the Q4 GDP growth rate actually came in lower than expected. Everybody was expecting about a 3% growth rate. It came in about 2.6%. So we don't know if that'll put a damper on flows going forward, but certainly we'll be able to tell you a little bit more as the week progresses. If you want to do a little deeper dive than what I just did and get into the detail of the fund flows and performance for the areas that you are interested in, you can go to our site at lipper.usfundflows.com, or you can join us next week where one of our analysts will talk about the flows trends for the week. Well, that's it for me. Thanks for joining me today. My name's Tom Rosine, wishing you the best in your wealth planning and creation.